And that is, well, why should I pay a fee on how much money I have? The answer to that question is pretty simple. It's the more money an advisor manages, the more risk they're taking on in terms of liability. It's not rocket science. It's been another 2 weeks. Lots of interesting things happen. It's never a dull moment in the markets and the United States. There's always some sort of panic happening. But here we're not here to talk about the panic and all the things going on overseas and the doomsday AI scenario. While these are all exciting things, I think they're kind of addressed a little bit too much in the media right now. What we're here to talk about, we get a lot of questions about this from clients. What we're going to talk about today is like how the sausage is made in our industry, specifically how much do advisors make, financial advisors specifically. So we get that question a lot. So that's going to be an interesting topic for us to unpack. But first, we just have some quick news announcements, things that have transpired over the past 2 weeks since our last episode. One of those is S&P 500 is officially in a drawdown now, down per my reading, which was actually on Monday. I haven't updated it. Maybe you've got a better update, but it was down about 5.9% from all-time highs. So everybody's panicking like it's down. It's in bear market territory right now.
Yeah. We peaked at, I think, 7,000 in the S&P roughly. And we're down somewhere in like the 6,600 range.
Yes.
So 400 points off 7,000. Ironically, I was looking at this earlier this week. Realistically, what happened is we've basically taken out any of the gains since the government shutdown.
Okay.
If you remember, the government shut down earlier in...
That was in November, right?
I think September.
September, okay.
September-October timeframe. Yeah. And I think had you asked most investors, hey, do you want to own stocks or not going into the government shutdown? Most people would probably say, oh, that's scary.
Yeah.
Let's not own stocks. And oddly enough, the market actually rallied through the government shutdown. And then we've now basically managed to retrace those gains. So we're back right about where we were pre-shutdown.
Yes. So it's just been a huge round trip. And I think now, honestly, is not a bad time to be an investor. So you were telling me earlier before we started recording that you love down days. And we were texting back and forth on Sunday when, what was going on? Oh, yeah, Taco. The 20, Taco stands for Trump always chickens out, And apparently he was going to, I didn't read this article. I read someone commenting on this, on his comments, where there was like, minute by minute, one thing was said, like, hey, negotiations are going on with Iran. And then the next minute, oh, they're not. Iran says, no, they're not going on. And then Trump says like something like, well, if they don't respond in 48 hours, we're going to bomb all their, energy facilities. Like it's like nobody knew what was going on. And there was all this hubbubaloo on Sunday in the Twitter sphere, FinTwit as they call it, about how market open on Monday was going to be a bloodbath, and of course, nothing happened.
The futures were down Sunday night.
Futures were down big time,
and then basically by Monday morning we had a news story, and the news story, and then we ripped 2.5% to the positive. This is why you have to be so careful getting negative in a headline driven market.
Yes,
because like as of the end of last week, I think we had 4 successive weeks of market declines, and that can just feel like that's just hard.
Yes.
Because watching your portfolio go down seemingly every day for a month, it's emotionally trying.
Yeah.
But then you have to remember that like at any given moment, you could have some headline come out and you could erase all of those losses like very quickly. So you just have to be careful getting too tied up or attached to the number that you see on the screen when you log in.
Yeah. You don't want to pay attention to this information feed that's coming in. With all this hyperbolic, oftentimes wrong data.
We don't really know what's going on.
Nobody does.
Like, I'm pretty sure these things are designed to keep you ignorant as they're strategizing things behind the scenes.
And a lot of times they're designed to purposefully manipulate retail investors. I actually got a chart. Here it is right here. So I'll put it up on the screen. Do you know that the volume of retail investor trades, this is a report produced by come on here, Citi Global Markets. So Citibank puts this together as the research arm. And retail trading activity only accounts for around 8% of trading flow.
Yeah.
So most of the trading being done day to day, we instinctively know this.
Institutional
It's
money.
institutional. It's, day trading algorithms and, a lot of these things are scraping news stories and there's even systems out there right now that are connected to the exchanges through laser connections that are designed to front run trades of these of other institutions that are taking longer routes to get to the exchange. There was this Netflix documentary about this that I watched. Apparently, that's been resolved, but you wonder, But anyway, this is what you're.
Well, I just want to, because I think there's an interesting story on there. When I started coming up as an advisor, that was a huge deal in the news. I remember 60 Minutes doing a story on this. What was happening was the hedge funds were spending a lot of money to essentially lay high-speed cables in the ground that went straight to the stock exchanges, with the idea being that when you as a retail investor would place this order on your computer, your order has to go through a series of cables and takes, I'll say, a long time, but it's really not a long time. I mean, it gets to New York very quickly, but because they have their own cable that supersedes the whatever cable you're tied into, they get there faster, like milliseconds faster. And how many millions of dollars? I mean, I don't know the answer to this, but they spent millions and millions of dollars to get just a fractional advantage.
And it makes a difference, know.
And this is not a new thing. An interesting story. There's recently been reading the book 1929 by Andrew Ross Sorkin, and in there he tells a story of Jesse Livermore. And Jesse Livermore in the early 1900s became very famous for shorting the stock market. He made a lot of money in the 1907 crash shorting the stock market. And even back in the day, you didn't have the way that stock orders didn't work was like, it wasn't wires in the ground. You actually had the exchange working, and if you were monitoring the market, you had like a ticker tape that was printing it out locally. And to get the information from the stock exchange in New York to your ticker tape would take 15, 20 minutes, whatever it was. And as volume picked up in the stock exchange, your tape would fall further and further behind what was actually going on in the exchange. And so now we think about this in like milliseconds.
Yeah.
But back then it's interesting because you actually think of it in minutes. So Jesse Livermore had this office in New York, and don't quote me on the exact amount of things, but he spent all sorts of money to have employees and phones, telegrams, like all these things back then, so that his employees could be like on the phone with somebody on the floor and get information faster than somebody else with a normal ticker tape. He spent lots of money in those days just to get that slight edge and be ahead of the retail investor. I think this is part of the reason why, as a retail investor, you just got to be careful, because the people you're trading against have lots and lots of resources.
Yeah, they do. And so, long story short, don't react to this news. It's best to just tune it out. You can't predict it, and a lot of times it's designed to manipulate you into selling stuff to institutional investors that you shouldn't be selling. And buying things from institutional investors you shouldn't be buying.
The news feeds on your emotions.
Yeah, that's right. That's right. So we're all being manipulated. All right. Next thing I wanted to cover is, I keep seeing this topic resurface, and it's about this thing called the K-shaped economy. So what does that mean? And other people don't know what that means. So the K-shaped economy is what I'm putting on the screen right here. This is a chart put out by the Financial Times. I ripped it off some Twitter user, so whoever that was, thank you, but I forget who it was, so I don't know who to give credit to. But what you're seeing here on the screen, so if I just took a line and just drew it right down right here, you can clearly see a K. You've got in the red the top 10% in terms of account earners, U.S. income earners, and then you've got the bottom 80%. And you can see there's a clear divergence in terms of share of U.S. consumer spending. You could relate this to assets. So this particular chart has to do with consumer spending, but you could also layer on like net worth and investment account balance.
Yeah, the wealthy are getting wealthier.
Yeah, basically the wealthy are doing a lot better than the bottom, in this case, 80%. So what I'm curious about is, well, where's the other 10% here? You got the bottom 80 and then the top 10. What about
Yeah.
What about the middle 10? But what I wanted to point out here is this is not a new story. We've been talking about it as if like this is something recent that occurred since COVID. And I think that while, yes, COVID did accelerate that, you saw a lot of high net worth individuals, their net worth accelerated disproportionately more than people who didn't have savings. But it's like, well, no, duh. That's because look what happened to stocks. You know, you had all this liquidity getting flooded, it's government money get flooded into markets. And what's going to happen? It's going to find its way into financial assets. But this really has been going on since, if we look at it, since the early 90s.
What I find interesting looking at this chart is that if you look at it, actually, we were almost at the similar levels to where we are now pre-2020. It actually almost right-sided itself in the middle of the pandemic as the top 10% represented less of the consumption.
Yep, right here.
And then it's actually just reversed.
Yes.
And we're really, pre-2020, I don't know exactly what year that is on the chart, maybe 2017 or something like that.
Well, what you see here is the effect of government.
That's everybody getting stimmy checks.
Yeah, so what happened is high net worth people were getting clobbered by poor stock market returns. And then the bottom 80% were getting STEMI checks.
Yeah.
And so the top 10% stopped spending and the bottom 80% were going crazy. Remember that?
Yeah.
Yeah. Everybody's going out buying new cars, boats. Boats were selling for premiums that still, I'm sure the retail salespeople are just frothing at the mouth. Like, let's just get another pandemic.
I remember reading a story. I don't remember exactly how many, but it was like the Wall Street Journal had talked about how many people owned RVs compared to how many actual spots there were to park your RV. Mm-hmm. And it turns out there were like 2 RVs for every available parking spot or something like that, just because people had just gone to town with these things in the pandemic.
Yeah. So, all right. Well, that's that. And then the last story that I want, well, there's two, actually a couple more. One is, so long to Chuck Norris. Did you ever watch him growing up?
Yeah. Walker, Texas Ranger.
Yeah. He is a legend. My granddad, on my mom's side, was obsessed with Texas Ranger. So, but yeah, I said seeking greater challenges, Chuck Norris decides to die at 86.
Oddly enough, the 2 things I remember before are Walker, Texas Ranger, and the Total Gym commercials.
Yeah, yeah.
My grandparents had one of those Total Gyms in their house for years. I've never actually seen it get used, but it was a lot of fun to play on when we were kids.
Yeah. So, we live so long to Chuck, that was a childhood. What's crazy is like, when I heard how old he was 86. I just, in my brain, I thought, well, he had to be 68. Chuck Norris is only 60. He died young, and I didn't realize, how old he was.
It's going faster and faster.
And then Robert Mueller, the former FBI director, passed away. And I thought, oh my gosh, was he assassinated? That was the first thing that went through my head. No, he was like, what was he, 89 or something? I was like, wow. So time is really moving, man. All right. And then final story that I have, and then I'm sure you might have one to cover, is that government debt, everybody's favorite topic, is up to $39 trillion.
Yeah.
$39 trillion.
That number feels really real.
Yeah. Nobody has any idea. It's the difference between $1 trillion and $1 billion is
a lot.
Crazy. What I've seen people do is they put it into the context of time. And they say, if you earn $1 billion, or if you earn $1 a day, to get to $1 billion takes or $1 a second, I think it was.
Yeah,
it was like 100 years, and then $1 trillion was something like millions of years. It was crazy.
Yeah.
Don't quote me on that stuff. I'm sure you can chat GPT; it'll give you an answer. But yeah, the $1 trillion is substantially more.
1,000 billion.
Yeah, it's 1,000 billion. So it's substantially more magnitude.
Count to
more.
1 billion 1,000 times.
Yeah, but what's really frightening is, remember when Trump came into the office, they had Doge, the Department of Government Efficiency, and we're going to rip out government spending, and we're going to right this ship and be fiscally responsible. The debt has grown. So the $39 trillion debt has grown by $2.78 trillion.
Yeah.
since Trump took office. Not even 2 years complete yet.
Like a year.
$2.78 trillion. Net interest expense right now, I actually got a chart on this.
I think I saw a thing this week on Warren Buffett apparently knows how to get Congress to get the debt under control. And he says nobody gets reelected if the net interest expense exceeds 3% of GDP.
That's interesting because if you look at this right now, and this is a chart directly from the U.S. Treasury, net interest expense, which by the way, for people who don't know what we mean, that's basically like interest on the debt. So think about it like in your mortgage, you've got principal,
how much
and then
money
you're
interest spending just to maintain the $39 trillion in debt.
Couple things about this. One is, and then we should move on to the main topic. One of those is that net interest is pure dollars going right into the system. People kind of forget that. That's money that the government is literally printing and giving it to people. That's interest. It's cash money.
The people that are lending this money to them.
So that's liquidity going out into this. So it further enhances like M2. And in addition to that, debt is
the money supply is what M2 is.
Yeah, exactly. In addition to that, debt is treated like an asset. So when you own a T-bill, that's considered by most people to be something on their balance sheet that they can exchange for goods and services.
If you go buy a government treasury and you have $10,000 in government bonds, you expect you can go get that money.
Yeah. So what this is doing, a lot of people ask me like, well, we're going to go belly up and things are going to go bust. Not necessarily, but what this is doing is deficit spending. It diverts inflation into financial assets and it exasperates that K-shaped economy I was telling you. So as financial assets inflate, because think about it like a glove. Like, you got one of those rubber gloves, you're blowing air in it. And what happens? Well, the air can only go into a couple places. It's going to go into the hands, it's going to go into the fingers, and everything's going to inflate in value. Well, that's exactly what deficit spending is. It's like, blowing air into that glove in an enclosed space. And one of those fingers is stocks, one of those is real estate. The bulk of it is bonds. But that's kind of the effect. I'm grossly oversimplifying it, but you get the point.
Well, and I think this relates a lot to like one of the things I was going to bring up here, which is that this morning we got a productivity number for Q4 of last year. And what it showed is that productivity actually dropped. Okay. And this matters because kind of to your point, and I think this fits into what you said in the sense that when the government prints more money, it doesn't necessarily mean the price of TVs goes up or the price of ice cream or whatever it is. Okay. There's some effect there, but when you produce a TV, for example, there's an element of that's, well, how much does it take? How expensive is it to produce a TV and how efficiently can we produce a TV? And if you've been buying TVs for the last 30, 40 years, you know that TVs cost less today than they did 30, 40 years ago. That's not because there's less money in circulation. That's because we become more productive at making TVs.
Yeah, technology is a deflationary
productivity. Productivity is like if there's something right now that's going to save us from the inflation, it's productivity. Because and that's why when you see a print like this morning come out where productivity actually went down and wages went up, wages are the biggest input cost as measured by revenue for the S&P 500. And so when wages rise, it's inflationary, and you need generally productivity to rise along with that to keep things stable.
Yeah.
But back to your point, there's a difference between inflation in goods, where there's an element of productivity, and inflation in assets. Like you can't make more Apple stock because the government produces money, right? So when the government prints more and more money and you have the same amount of shares of Apple, the shares go up.
Exactly. And same with real estate, same with any what I call natively scarce asset with social utility. It's all going to inflate.
But for the goods and services we buy in our daily lives, you've got to remember that there is an element of that, which is how effectively can we produce those goods and services?
Yeah. So back to the main point. Net interest expense here is $425 billion. It's projected to be about $2.2 trillion, or actually no, $2.8 trillion by year 2030. So this is a problem. And it's going to continue to lead to asset price inflation, most likely goods and services inflation too, unless this whole AI dream of like roboticizing everything comes into fruition. I mean, that's possible. It really is. So we could see, goods. It is possible to see a runaway asset price asset prices, but also at the same time, going to get an ice cream cone cost 5 cents
this
again.
is kind of what happened. If you think about the market from I'll just pick an arbitrary date, like 1980 to today, think about how the computer transformed things. I remember when I worked at Fidelity, they used to talk about how they could manage, back in the 80s, to manage all of the 401k assets Fidelity had. They employed a team of I think it was 500 people that they employed to manage that. Now they do the same thing with 5 to 10 people. And so I guess that's kind of my point, is that we are kind of banking right now on AI being like the computer in that analogy, and allowing asset prices to go up and all of these the economy to grow without cranking up the prices of all of our goods and services. Because technology is deflationary. Technology puts downwards pressure on prices.
That's a great way to top off our news story, and let's move on to the topic du jour, which is how much financial advisors get paid. How much are you willing to disclose on this, Brent?
Well, I think we're going to get into it.
Well, yeah, and I think a good place to start is really in describing the difference in advice models, because there has been a lot of confusion. I think most people, if I'm going to assume here, I might be too strong an assumption, but most people just kind of lump financial advisors all into one bucket.
Totally.
And they just think, oh, this advisor does the same thing as this advisor, does the same thing as this advisor. Financial advisor is a general term that covers a lot of different professionals. And I'm going to name 3 in particular. So the first professional is a broker. I think that's the traditional way people view financial advisors is just some Wizard of Oz behind a curtain that's recommending stocks and pulling triggers on, buying and selling positions within your portfolio. And that's pretty much all they do. It's like the, Pursuit of Happiness vision. Will Smith was in that movie, and he was working for Dean Witter, and was super successful. But and they Wolf of Wall Street is another one.
Call this dialing for dollars.
Yeah, dialing for dollars. So that person's considered a financial advisor. Believe it or not, these people still do exist, but they're not a super common variant. The other person that I see that's considered a financial advisor is an insurance agent. So even attorneys. So attorneys basically, that are insurance agents masquerading as financial advisors, and a lot of times they're using estate planning angles. And they can use the term financial advisors. And then you've got the field that we're in, and we're considered fiduciaries. That's the F word thrown around to describe us. And we're considered fee only or fee based advisors, which, we're going to get into each of these and describe each of these.
To me, it's important to understand the context of the background, how did we get here? And years ago, the broker really existed because the lay person needed a way to invest. It was the buying a stock wasn't something you couldn't just log on your computer and buy a stock. So you needed a person in between you and the exchange to broker that transaction. And for doing that, that person got a commission.
Yes.
And what happened was, years later, really, and Vanguard was a big driver of this. Vanguard created the index fund, and they put out all this research about how stock picking was actually not adding a lot of value. And it really challenged the industry as a whole to go, okay, what are we here for? Are we here to sell products, be it stocks, insurance, whatever it is, or are we here to provide advice?
What's interesting about that is Vanguard did not did not really catch on until the internet caught on, because the distribution model that Vanguard took, because their fees were so low, put them at a disadvantage. So the most common mutual fund that was sold back in the 80s and 90s and even the early 2000s were what are called front-loaded funds, otherwise known in the industry as A-share mutual funds. They also have C-share and B-share and all that
all
stuff.
Sorts of share classes.
I don't need to get it. They're all commission-based. So what that means is that you pay a fee when there's a trade in your account. And I shouldn't say only, but typically
this
the fee.
This gets how do we get this without being confusing? The share classes. I mean, this is why it's all a rigmarole. I mean, to us, okay, like I'm just going to skip to the end here. For us and what we do, we are considered fee only, or I'm considered fee only. The benefit of that is if I'm receiving money from you, it's getting debited out of your account. Like there's not a product or something that we can sell or invest you in where I'm getting paid something that you don't see. But in the traditional mutual fund world that you're referring to, the share class world, you have alphabet soup of share classes. There's A shares, B shares, C shares, blah, 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 blah. And each one of those has a different internal cost structure that the client, by the way, doesn't really see.
Yeah.
That then kicks money back to the advisor that, again, the client doesn't know about.
Well, let's detail that a little bit. The most common ones that I would see since I got into the business were these A share structure funds. These are not too difficult to understand. So let's just take $100,000, for example. So you have $100,000 to invest. You call your broker. All right. So this is a person who earns a commission. They typically have a Series 6 or a Series 7 license. They're affiliated with a broker-dealer. Broker-dealers typically have names like Merrill Lynch, Edward Jones. There's a thousand of them out there. Dean Witter was one of them. And you take that $100,000, you put it into we'll call it ABC fund, or we'll call it XYZ fund, with Class A share. Right off the top, typically around $3,000 to $6,000 of your $100,000 goes right to a fee. It's between 3 to 6%. Back in the 80s, these things were like 9-10% loaded. Yeah. They were very expensive. And the reason why they sold instead of Vanguards is because, Vanguard didn't pay anything to the advisor.
Yeah.
It was direct to consumer. So why would a financial advisor recommend a product that didn't consider his compensation? Now, the fee-based structure that we're going to talk about in the future did exist at the time, but it wasn't really popular. So that's how a commission broker works.
Well, and it's worth mentioning that in that process, when you reach out to that broker to buy that A share and pay that commission, that broker does not have a fiduciary responsibility to you.
Actually, best interest standard applies to IRAs, but otherwise it's called a suitability standard. It means that the product doesn't necessarily have to be in your best interest, it just has to be suitable.
Yeah, you told me that you don't like risk of, it just has to kind of fit the general profile. It doesn't actually have to be in your best interest.
Yes.
And so this role is much more of a sales role, of a connecting a buyer to a product as opposed to consulting the buyer on what product makes the most sense and how it should be incorporated.
Yes, and it typically, I call it the fire and forget model. So a client or an investor looking just for a broker to just say, hey, here's a portfolio set, recommend it, and I never want to see you again. That may be the right model. It actually over time may even be lower cost. But then I question, why don't you just DIY it? I'm sure you could find a free resource on some internet forum.
You could just buy the Vanguard fund and save the money.
Or one of these target date funds. But anyway, this model is becoming quickly outdated for reasons that we're going to get into. But a broker can make anything anywhere. I've seen these people make absolutely nothing because they can't sell. It's a very sales-oriented career. So if you're bad with people, you're not going to get any clients, so you'll burn out. And I've seen brokers making millions of dollars a year. It's all over. It's like realtors.
Well, because you don't have to act as a fiduciary, you don't have to, you could have 10,000 clients, and you could not talk to any of them. And they just happen to hold the fund with you, and you get kickbacks from that fund on an ongoing basis, but you have no ongoing obligation to those clients.
There's zero. And here's another problem that I see with the brokerage model. And this is I think the major problem today. And that is brokers and their sales practices around complex products, specifically variable contracts, so like variable annuities with these living benefit riders. Most of the financial professionals I watch don't even understand these things themselves. Do you know what I'm talking about?
Yeah.
Okay. So how many times have you sat down with a client, they're getting a proposal from some dinner seminar they went to or some presentation that they, downloaded, And they're saying, look at this fund. It grows by a guaranteed 7% per year. And you have to unwind all this, because that's not true. And what happens in these brokerage models, because a lot of these variable contracts, not all of them, but a lot of them, most of them, I would say, are sold in what's called a B share arrangement, where you put your money into it. So again, take the $100,000. You put your $100,000, into an annuity, and that annuity is locked up for a period of 7, I've seen as long as 20 years.
Yeah.
And if
the surrender period.
Yeah. If you change your mind, you're like, next year, you're like, you know what? I want to take that money and I'm going to go, do something different with it. Well, now there's a penalty, and that penalty is pretty steep.
And the penalty is there because the advisor that sold you the annuity got a big paycheck.
Exactly.
And the annuity company needs to make sure they get all their money back for what they've already given the broker.
That's right. And what happens, like way more than it should, it's depressing actually, is that people get sold these contracts. The agent or broker gets paid the fee. They ride off into the sunset, sayonara, and now the consumer's left with this complicated product they don't understand, and they end up blowing it up. Sometimes these things actually aren't so bad. I've read these contracts before, and they do fit in certain scenarios. It's not like they're all bad. I'm not like going to adopt the Susie Orman methodology saying like, hey, VAs are bad across the board. But generally speaking, I think that the propensity for brokers to sell these things for the commission rather than what's best interest for the client is just too great.
Well, and I think that's the point. So like transitioning to fee-based advisors. So like us, for example, and there's lots of fee models. There are advisors that would pick on our fee model and what have you. It's always easy to pick on everything else. But our goal is to have a transparent fee, either a percentage of assets or a fixed amount that comes out of your bank account. And because of that, we're not incentivized. Like if you were to go buy this annuity, and there are annuities out there that don't pay commissions to the advisors and don't have surrender charges, things like that, you want to know that you're buying it because it makes sense for you and not because I get paid more to sell you that one versus another.
Yes.
And so I think it's really important in these models to kind of identify where the conflict of interests are. And conflict of interest is inherent to any of these models. I mean, you're always going to have a level of conflict of interest involved in these things. But you as the consumer, and I think one of the reasons I feel it's really important to be on the fee-based side is the way I see it. I kind of live in the center of the client's financial picture. Typically a client might feel like they've got to coordinate their CPA, their attorney, their investment advisor, their insurance person. All of these people are kind of like spokes to the wheel that they're in the center of. And where the advisory space has tried to go over the last, maybe let's just say 30 years, is that we want to be less kind of the one spoke of just selling you the investment. We want to work harder to get to the middle of the wheel with you to help you manage each individual spoke. And so in an example like ours, I'm not a CPA, you're not a CPA, we're not estate attorneys, we're not insurance salespeople. But one of the things that we do for clients is that we get together with them, and based on their situation and their needs and all those things, we say, hey, you ought to consider these kinds of insurance, and this is what we need to think about, and here's the insurance person we're going to get involved to make that work. You need to consider these factors within your estate plan, and here's how we're going to communicate with the estate attorney so that we can implement this successfully. Here are the things that are sensitive in your, that are relevant to your tax situation and are nuances that we should be aware of with your CPA, and then working together with the CPA to do this. So it's just bringing all of those spokes together and doing all of that instead of for a commission or an incentive type fee, doing that for essentially a consulting fee.
Yeah. So what you're referring to is the fee-based advisor, otherwise known as the fiduciary. I don't know how to cover that much better. So I think you've described that relationship. The only thing you haven't described yet is how that person gets paid, but I do want to revisit that. First, I want to touch on the whole aspect of agents, insurance agents functioning as financial advisors as well, because this is kind of a hot topic. It's got a lot of people bent out of shape because there is even a proposal with, I think it's FINRA or the SEC going on right now. I can't, don't quote me on that, but I'm reading about it. There's a proposal to actually remove the terminology of financial advisor from being accessible to anyone that is not either a fiduciary or a FINRA registered representative. So an insurance agent is simply someone who is licensed with their state or a series of states to offer fixed insurance products. So they have no ability to offer anything that's variable. Anything that's variable means stocks, bonds, things of that nature, things that their price varies from day to day. So an insurance agent, generally their product set consists of fixed annuities and indexed annuities. Or whole life insurance or universal life insurance. So these are products, and I mean products. They're not solutions. They're products first and foremost that are function more or less like sophisticated savings accounts combined with some form of insurance contract. It's tough for me to see how this person could be considered a financial advisor. I don't think there's much redeemable about it. And frankly, I would say, like, if you're meeting with someone and this person does not have the ability to have like a comprehensive product set, whether it be access to stocks. I mean, that seems like pretty rudimentary to me, but access to stocks, access to mutual funds, even, or even any variable product for that matter, I would probably keep shopping and go find someone else. But this is a variant of the broker, but they're even more stripped down in terms of what they can offer. So I just wanted to touch on that.
And one of the things that we believe in general, it doesn't apply in every case. There are, of course, exceptions to the rule, but insurance should be designed for insurance and investments should be designed for investments. Typically speaking, you don't want to mix insurance and investments.
So let's get back into your description of the fee-based advisor. I think was very good. As the center of the wheel, and you're more functioning like a quarterback. You're coordinating all these professionals, including the insurance agent, and
you're getting paid an ongoing fee, which I think is important because unlike a commission where it's really, really lucrative to court you up front. And then once you're on board, most of my money's paid up front and then the ongoing is much less. In these kinds of arrangements, generally speaking, the compensation is on a regular ongoing basis. So the incentive from the advisor's perspective to keep $1 million client is equal to the incentive to gain another $1 million client. And so it's really, I think that's so important because time and time again in my career, I've heard clients say, oh gosh, they were really great until I moved my money over and then I never really heard from them again and things like that. I think it's really important to find an incentive structure that aligns you with a partner on an ongoing basis and puts you in a position to be able to move. I mean, realistically, if any of our, unlike with the annuity where you get penalized to get out in a certain period of time, if you have a fee-only advisor and you want to move your money, there's generally no penalties to do so.
Yeah, I think that usually liquidity is the thing that signals whether or not you're working with the right person. So I think it's important for people to have as little buyer's remorse as possible. So when you're working with a financial planner or advisor, one question you can ask them is like, okay, in 1 month, if I change my mind, how much do I lose? Excluding market variability, because nobody can predict that, right? So, if the answer is anything other than, a fraction of a percent should be the equivalent of the fee that you've paid over that 2 months. It shouldn't, in other words, it shouldn't be something like 5 or 6%. It should be, the answer to the question should be a fraction of a percent.
Yeah.
And that's a good litmus test, like if you're working with a fee-based advisor. So the idea of a fee-based advisor is that you either pay, there's two functions, or two methods that I've seen, basic categories, is you either are paying an asset under management fee, so that this person, you're paying this person a percentage of your money.
On an annual, so like 1% a year,
Yeah,
$1 million.
most often it's quarterly. It's taken out of your account per quarter. It's an annualized rate. Let's say it's 1%. I've seen all over the board. I've seen
Legally, it cannot be higher than 3%, is my understanding.
that seems high to me. But
3% would be a lot.
Yeah, I think industry standard is probably somewhere like 1.25 to 1.5. I think for a live human advisor, there's robotic advisors that charge less than that, but that tends to be the standard rate. Now, I would say that's just my anecdotal experience in reviewing accounts. So, I don't know what the actual average is, but I suspect that that's pretty close. The other method, and this is gaining a lot in popularity, is this flat fee method. And that is, well, why should I pay a fee on how much money I have? The answer to that question is pretty simple. It's the more money an advisor manages, the more risk they're taking on in terms of liability. It's not rocket science. Like the AUM method to me makes a lot of sense.
Yeah, if you have $10 million, the mistakes are bigger mistakes.
Exactly. They're huger mistakes, and the plans are more complicated. It makes a lot of sense why, and by the way, Vanguard does that too. You don't pay a flat fee to have your index fund managed.
Yeah.
You pay. It's the basis point model to me is one of the more sensible ones. That kind of goes against the grain. A lot of consumers are like, well, why should I pay more? Why should I pay more? Because I have more money. It's like, well, that's exactly why. It's because you have more money. But the flat fee model is taking off. It does exist. So typically these advisors are not managing money though. What they're doing is they're giving you advice that you have to implement.
Right.
So which takes a lot of the burden of implementation error off their plate. So, this would be the average fee I've seen is between like $6,000 to $10,000. Now there's some complex per year. There's some complex planners that charge a lot more than that.
Sure.
That charge a lot more than that. But that's like when I'm looking at the advisors that are addressing the mass affluent market, that tends to be their fee range. It's usually not less than $6,000. So, which is funny because a lot of people think they're going to save money going into this model, and a lot of times they end up paying more, simply because the advisor has to build in an inflation adjuster into their price. But those are generally the two models. Both are good. I just think you have to pick the one that's right for your situation.
Well, one thing I've always found interesting is that there's a lot of clients that also tend to ask about hourly. Mm-hmm. And I really have maybe a philosophical beef with hourly in our industry, because I think like part of our job is helping clients quantify the value of the questions that they have to ask. And anybody that's ever paid an attorney before knows that like when you look down at your phone before you're going to call the attorney, you're like doing math in your head to ask like how much is this phone call going to cost me versus how much can I save? I think it's really important that your advisor creates an environment where you feel safe and you feel encouraged to ask questions, because really from my perspective, it's a part of my job to help you figure out how valuable your questions are. And if I put a barrier between you talking to me that's you trying to measure the value of your question relative to the cost of me, I think I've kind of nerfed my ability to help you.
Well, you've disincentivized clients
communication
from talking to you.
Yeah. So I think that's really dangerous. Like, I think from my perspective, you want to encourage clients to reach out to you with whatever questions they have. And then sometimes my answer might be, hey, that's a great question, but it doesn't have a whole lot of impact. Other times, there might be a question that a client didn't realize had a big impact to their finances, but I can bring that up. And I just don't philosophically agree with charging an hourly fee for that reason. So in my case,
I'm sorry to step on you.
Sure, no, go ahead.
Yeah, I just want to interject here that it also implies that you should only be communicating with your advisor and on an hourly basis or an infrequent basis. And I think that's not really great. So, for example, like think about we're almost like therapists in a way, right? Money therapists, vocational therapists, family therapists. You don't go to one therapy session and just say I'm cured. Here I go. That's not the way it works. You need an ongoing relationship, and the hourly model really, for the reasons, disincentivizes it. It kind of disrupts that whole thing. Sorry,
I kind of agree, and I don't want to come across like there. I know some people that are great people that do hourly models, so I'm not trying to say it's. I mean, it's definitely out there. If as a client you are so inclined to get an hourly model, please, by all means, it's your life. From my perspective, I think that it can negatively impact the amount of value that the advisor could deliver. That might not get there because there's a gap between. Reaching out, there's a disincentive for you to talk to them.
Yeah, I don't think it can. I think it will. I don't think it's a matter of question. So now we've described all these models. Let's talk about how much advisors like us actually make, because that's what people really want to know. So I'm going to peel back the curtains and explain how much advisors make, but I also want to describe. We're going to focus on fee-based advisors, as I've already discussed, like commission-based brokers and agents. It's going to be dependent on how many sales they do, and it's going to change every year because.
But my understanding is when somebody sells like a whole life policy, they get paid. They can get paid. Let's say between 60% of the first year premium and sometimes over 100% of the first year premium. So you have some advisor that sells you a whole life policy, and let's say it's a $30,000 a year premium. I mean, they may be making tens of thousands of dollars.
Well, it's possible. Yeah, what you're referring to are called trails. So
that's the first year premium. That's the commission, right?
That's just the generic term used in the industry to describe ongoing compensation that's paid to the selling broker or agent after the point of sale. So, an example in a mutual fund, and again, this does not apply to fiduciaries or fee-based advisors. This is just brokers and agents. Let's say you sell a variable annuity, and that pays a 5% upfront commission. So let's back to the example of 100,000.
5% is like that's not the end of the world. I mean, I was surprised to learn in doing some of this research that when you sell like permanent life insurance policies, you're picking up, I mean, in a lot of cases, almost the entirety of the first year premium. I mean, think about that. I had a client where we were switching life insurance from a whole life policy that was actually junk.
Yes.
And we swapped it into a long-term care kind of policy. Now, I was not the broker that sold it. Right. We through the planning, we identified the need. We looked at the existing option. We scouted out other options, and we ultimately made the intentional decision to make a switch. Like, how much compensation did I have to give up for somebody else to sell that?
I caution to go into this topic because I have very strong feelings about it. So I'm actually going to reserve these feelings. But I'm just going to say, life insurance pays a crap load of commission to the selling agent for a reason. And the reason is probably not in your interest if you're the consumer. So let's just leave it at that. But yes, a permanent life insurance product, because of it has, if it's sold on a commission basis, there are fee-based permanent contracts out there, but they generally have very long surrender periods. I had a client that one time put $50,000 in a universal life policy because the agent said, "Oh, the insurance company's going to match your premium." What he did is he put the money in, and the agent had a loan taken out for the full premium and put right back into the policy. So yes, while he had technically $100,000 in cash value, it was $50,000 principal. Yeah, it was a levered policy, and then of course
that could blow up.
He has me review it. Oh, it did blow up. He has me review it, and I'm like, "I'm sorry, this is a bad deal." And then we went to surrender the policy, got $2,000.
Yeah.
So you tell me where the money went. So anyway, I'm gonna get off that tangent and go back in
what we do.
The description of the two different kind of models of financial advisors work in. So you got the employee model, and then you've got the business owner model. So a lot of advisors are employees. So you're an employee of Fidelity or you're an employee of Edward Jones. Those are two companies that utilize an employee model, meaning that you don't really own the business. You're just working in the business.
You're the face of the company for the client.
So in that particular model, if you're a seasoned financial advisor, it's reasonable for you to expect an income between 150 to 250,000. You can easily make that. That is considered a competitive rate for an experienced financial advisor. If you're just getting in the business, as you're going to start out probably substantially less than that. So, I would say let's sub 100,000. If you do the hard work and you go get credentialed on top of it. So let's say you go and study and get your CFP credential, which mandates at least 2 years of industry experience, right? Is it 2 or 3 years?
It depends. Are you
okay.
2 years if you train under a CFP, 3 years if not?
Okay. So thanks for clarifying that. But so there are some experience thresholds to get some of these credentials, but that can help you make even more. But typically in an employee model, you're going to cap out, there's some exceptions to this rule, but you're going to cap out at around 300,000. I would say that you eventually get to the point where you're too expensive, and they hire younger people and kind of carve away your clients
because they've got a P&L to manage.
Yes, they do. Now, then there's the business owner model, and I would throw in a lot of wirehouses into this. Even though wirehouse brokers are technically W-2 employees, they really kind of own the client relationship.
Yeah.
So, examples would be like Merrill or UBS even.
If you're like a team within like, let's say a Morgan Stanley.
Yes.
Your team owns your clients. And so your clients are yours and what have you. But then Morgan Stanley has control over what products do you sell? How do you generally do this? How are we going to pay you on what your clients pay? And typically what happens is they try to work the system to try to keep you retained. Since they don't actually have true ownership over your book, they try to create they have like
they have to incentivize you to stay around.
Yeah, so they create incentives and then they create like handcuffs.
Yeah.
So like if you have an older advisor who retires, the firm will then help the younger advisor buy the book. They'll give like the younger advisor some advantageous deal on financing to buy that. But if you leave, you give up that advantageous deal. And so they kind of give you a reason why you're not going to break out.
Yes, but that's like, I would call that maybe stage 2. So working in a W-2 environment where your clients are team owned or they're owned by the entity in a quasi sort of way, but you own the relationship and your employer knows that if you leave, those clients are probably leaving too. So, you get showered with money typically. And advisors can make buku dollars. I know my neighbor was in this type of model, and I think I was making over $1 million a year.
Yeah.
And that's not uncommon. It's not uncommon for these high producing advisors in this wirehouse style or independent broker style environment to make that kind of money. Then there's a stage after that. So the stage after that is like, okay, fee-based independent RIA. So what RIA stands for is Registered Investment Advisor. That means that this is a company that has been set up, from the ground up, typically, like ours. The firm that I own is, set up at the ground up, and it's registered directly with the Securities Exchange Commission. If they manage under 110 million, which is not the case for us, but if the RIA manages under that, then they typically register with the state in which the business resides. But most of them are done through the SEC. Well, I shouldn't say most of them. Actually, most of them are state registered. They're smaller shops, but shops like ours are, directly registered with the SEC. All right, and then they partner with a discount broker or a custodian. So a lot of times you'll see people working with their clients and their statements are coming from Charles Schwab.
Right.
That's confusing because Charles Schwab, they have their retail employee advisors, but then you're going to this independent firm that doesn't have Charles Schwab on the door, but my statement comes from Charles Schwab. What's that all about?
Sure.
And it causes a lot of confusion. What's happening is Charles Schwab is one of the major, actually, they're the largest provider of institutional level custodial services. So firms like ours, unlike some of the wirehouses, we do not custody client money. So,
Right. When you work with a Morgan Stanley team, your money's at Morgan Stanley.
your money's at Morgan Stanley. When you're working with a team like us, we don't have your money. And that's probably, actually, that is a good thing. Yeah, because that's what Bernie Madoff did not do. He custodied money and he produced his own client statements. So, firms like ours use proven high quality custodians like Schwab, like Fidelity. There's many out there. Those are the two biggest right now. And, they provide all that, money.
Just the infrastructure.
Yeah, they basically park your money and they provide the infrastructure. They do the trading. And why wouldn't we as a fiduciary recommend them? Because they're a great service. So, but I did want to shed some light on that because that is very confusing to people. It's like, well, why is my statement coming from Schwab and yet your company says, NWMG? It's like, well, that's the reason. So, but what independent registered investment advisors can make is really the sky is the limit because this is a bona fide business. So we can take this business and we can, you and I theoretically could just say, you know what, we're done. I'm retiring, and you just sell it off. In fact, there is a huge movement going on right now. This is a small business area of top PE targets. So PE being private equity. So this is basically people with a boatload of money. They're looking for small businesses, and one of the largest takeovers. Targets has been, businesses under $25 million. Well, what's going on in our space right now? Most of RIAs are worth less than $25 million.
Yeah.
You're seeing a huge private equity push to gobble up these businesses. And the reason why that is because the margins are very strong. Our industry brags about having like 40% margins, which, as if you're in retail, that's a very strong margin. So I can't answer the question like, what do financial advisors that are running independent practices make? Because it's largely dependent on their business model, how efficiently they operate, how many clients they have, and then the fees that they charge.
Well, while that is true, there is some data out there that suggests that there's a sweet spot. And there is like a right amount of money to make and a wrong amount of money to make. Okay. And so if you look at the research that's out there, Michael Kitces publishes a lot of this. He's one of the kind of the leading financial planning researchers. Yeah. His research would suggest that if your firm produces less than $3,000 per client per year of revenue, you won't have the money to reinvest in your business. You won't have the ability. You will ultimately go out of business because you don't make enough per client to support the business.
Yes.
As you go above 3,000, kind of the sweet spot is, let's say, 7,000 to 10,000 per year per client in revenue. And that's the sweet spot because complexity is still kind of low, but comp has gone up. Once you start to get significantly higher than that, complexity ramps up faster than revenue. And so it just depends on what shop you want to be. But if you look at the statistics, the best advisory firms are generally averaging, let's say, between $7,000 and $10,000 per client per year in revenue. Typically speaking, one advisor, depending on how they're structured, the ideal structure is what's considered the ensemble team with an advisor, a paraplanner, so kind of a support advisor, and then a service person. The math, so to speak, the research would show that three-person team can handle somewhere between about 100 and 150 clients consistently with success. And once you get there, you have to really start scaling more ensemble teams.
I wonder how many hours that is, because I'm over that, and my team is handling things. So,
I mean, obviously these are generic statistics, but I think and back to your point, it depends on the model. Like I'll give you a great example. So for a lot of our clients, we meet with, our average client we're probably meeting with quarterly. And so we're having multiple meetings a year. Sometimes we're having even more frequent meetings if things need to happen. So there's a lot of time, labor. These are deep relationships. We help with coordinating taxes. We help with coordinating estate planning. So if all you're doing, going back to the broker model, if all you're doing is selling a fund and then never talk. Like you can handle 1,000 clients. It's very easy. But if you're actually going through the whole financial planning process where you're touching on investment, retirement, tax, insurance, estate, all of these things, it just takes, it takes time. And it's not the easiest thing to scale. Like one of the things I think our listeners need to remember is that for me to make the most money possible, I manage the most amount of assets and I do the least amount of planning, right? Because asset management is actually very scalable. You can put client portfolios into models that can be traded across accounts. So you could trade 15, 20, 30, 100, 1,000 accounts all in a few clicks, but there's no way to give personalized financial advice to 1,000 clients at once. Like you have to piecemeal it and you have to spend the time. And so I think this is what's so hard is in our business, the highest margin firms do the least amount of planning because that's where your time is lost. And it's just, so one of the things we want our listeners to get out of this pot, like if there's anything that we want to be able to teach, like when I think about what we want to get out of this podcast, like it's great if people listen to us and think it's all, but ultimately we want to help our listeners get themselves better help. Whether it's us, a different advisor, or doing it on their own, we want to help people figure out like how to sniff out what's a good advisor, what's a bad advisor, what is good advice, what should I be, those kinds of things we feel are helpful in your life beyond just us.
Do you think it's appropriate for a client to ask how much do you make?
Yeah,
wouldn't that be a signal whether or not you're in one of these advisors that spends more time managing than planning?
I don't think it's inherently a bad thing to make a lot of money. I don't think that's like, could you go to one advisor that makes $200,000 a year and go to another advisor and makes $1 million a year, and inherently the guy making $1 million a year is a jerk? Like, I don't think that's how it works. I think you have to take into context, like, what am I getting? And you should be getting somebody who's unbiased that's going to help you with a handful. If all you're getting is somebody managing your portfolio, not talking to you about tax, not talking about estate, not talking to you about insurance, et cetera, et cetera, et cetera, and you're paying a 1.25%, 1.5% fee, like you should be asking for more.
We'll go ahead and move on to the tip of the day because I don't think there's anything else that we could add to this topic that we haven't addressed unless you can think of something.
Well, I just think that there's maybe this misconception out there that like, financial advice is expensive. Maybe this is how I would sum this all up.
It is because it needs to be. That's the way the model is.
I agree, but I kind of posture the question, like, here's a good example. I meet with an engineer. The engineer says, hey, Brent, I can do all of this on my own, not pay you 1%. And like, are you going to make me more money than what I could do on my own? And I would argue with that person that my goal in that relationship is actually to leave them, it is going to sound weird, but like to leave them with less money than they would have had on their own. Because like that person, frankly, is going to save themselves, is going to save a ton of money. They're going to invest. They might, but they're doing so out of fear a lot of times. And I've seen it time and time again. I just pick on the engineers. There's a lot of people like this that aren't engineers too, but
the engineers are the worst, though.
I don't want to say the worst. Like that's not fair to them. But the point is how do you define success in your financial life? Is success measured by dying with the biggest amount of money possible, or is success measured by achieving balance and accomplishing the things throughout your life that take money to accomplish? For me and for a lot of the clients we work with, one of my favorite things to do, and one of the things I think adds the most value to them, is give them confidence to use their money. I don't want them to die with $100 million that they, or 50 million or 30 million or 20 million. I want them to die in a way where they got to use their money over the course of their life. I don't want them to pinch pennies and not take their kids to Disney so that they can die with an extra $5 million. Unless that's actually what they want. But most of the time, people want to use their money. They don't want to just die with a big number. And so I guess when I think about the value that I add for people, it's twofold. On one hand, there's a lot of logic. How do we get your estate plan right? How do we get your taxes right? How do we invest you properly? Then there's the emotional side. How do we help you live a more intentional, purposeful, richer life than you would have lived on your own through the planning that we provide?
All right.
What's your tip of the day?
My tip of the day is actually related to a lot of this education fear or this job displacement fear. So a lot of people think that, AI is taking over the world and their jobs are going to be displaced and all this. And, they don't do anything about it, because what can you do about it? And I am happy to say that there is something you can do. So if you can't beat them, join them. And that's why I'm going to suggest people check out Anthropic Academy. So for those who are been living under a rock for the last 5 years, Anthropic is the company behind the popular LLM Claude.
Sure.
So, and they've got this entire, you can just go to anthropic.com/learn. They got this entire completely free academy where you can enroll in classes like how to code in Claude, Claude 101, build with Claude, Claude for work, Claude for personal. So they've got this great training program where you can just enroll in this stuff and learn how to use it. If you're not using LLMs in your life right now, especially professionally, you should be worried. You really should be worried, because this is the future. And you should not be you should not be outsourcing your work. There was a story of a gal who got terminated, and she was a remote employee for a law firm. And they logged into her computer and found out all of her workflows, every single one, was flowing through ChatGPT. Like, she wasn't doing anything. She's completely outsourcing all of her thinking to ChatGPT and copy pasting. You should not be doing that, but you should be figuring out how to weave this stuff into your life to enhance your performance, to enhance your productivity. And I think this sets you up to do that correctly. So, I've enrolled in a few courses. I'm particularly interested in Claude Code. I want to see, is it possible for me to actually code something? So I'm going to give you guys a report on that, hopefully in a few months after I tinker with it. So that's a really neat resource. As a side note to this, because some people in the jobs market, they're being displaced, and, that's very painful. And my heart goes out to you. But at the same time, the solution isn't to, sit and lick your wounds and binge watch TV. It's you got to retool yourself. And so this is one area you can do it, but there's also a site you can go to called Udemy. Have you heard of this?
Mm-hmm.
So
you showed me this a while back.
Udemy.com is a place. It's kind of like a paid for YouTube, but you can actually learn specific things. You can purchase courses sometimes for like $5, $10. They're very cheap. That's actually where I learned how to start doing this podcasting, was through a Udemy course. So that's another thing you can do. So you don't have to go to a university to get training. It's actually, education's never been cheaper. It's credentialing that's expensive, and sometimes you have to get the credentials and you have to go pay those university fees. But if you're just learning, hey, how do I do video editing, or how do I do carpentry? There's so many free resources out there that you can go into, and here's 2 of them. So. All right. Well, I appreciate everybody hanging on this long. We went a little over today, but we had a lot to unpack. So if you have any questions or comments, it's comments@moneyalchemistshow.com. But that email is in the show notes, as are the links to the tip of the day.
Great. Thanks, Ben.
All right. Catch you guys next time. Opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. Investing involves risks, including the potential loss of principal. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Advisory services offered through National Wealth Management Group, LLC.